Eat the Rich, the Netflix special that just came out. All right, I watched it. I'm going to give you my thoughts on the documentary. I actually recorded an entire series about this, about shorting GameStop and the entire GameStop saga way back a year and a half ago. And I'm revisiting today, right here, right now. Hey guys, I'm Rob Tetrault, Portfolio Manager here at Canaccord. We're talking about Eat the Rich, the Netflix documentary, effectively telling the story of the GameStop saga that happened in 2021 and even up until now. So the story is one that I really enjoyed watching, mostly because I knew that my clients would call me on it, would ask me about it, and individuals would want my opinion on it. So here's my big picture opinion on it. First of all, it tells a good story. All right. It's a documentary. It's made for you to enjoy watching it. There's a whole bunch of gotcha moments and a whole bunch of conspiracy theories, etc. But in reality, the theme that they're trying to paint, right? The theme that they're trying to paint with this documentary, that Mr. and Mrs. Everyday Investor that just got on their phone and stuck it to corporate America, or stuck it to the man, one, I think is false and fictitious. And two, more importantly, the fact, their theory that Robinhood ended up hurting the GameStop rocket ship to the moon is, in my opinion, patently false, and it's not representative of what really happened. Now, let me take you through both those hot takes. First off, let's start with the Robinhood take. So the Robinhood take.
Robinhood is a brokerage web app, phone app that facilitates trading. Make an account on it, you can buy and sell stocks.
The idea is that because Robinhood took away the buy button at the key time in the stock development, that it prevented the stock from going further. So here's the thing. There were very, very few buyers left. And if there were some left, yes, there were a few left. But at some point, the stock was going to run out of buyers, run out of ammo to keep propelling the stock forward.
Everyone thought GameStop was the next blockbuster.
A lot of people thought GameStop's overvalued. No one's going to these stores buying. They just thought the stock should go down.
Video game retailer GameStop is not doing so well.
Okay, because the stock cannot keep going up unless we are all dumping capital blindly into the stock. The only way it works, because the company is not worth $300, right? We know that the company's not worth $300. The only way this works, the only way this game works, is if we continue to convince the masses to invest all of their money into the stock.
Going on in GameStop right now conceivably could take a couple of hedge funds out.
Cuba, Italy, Singapore, Scotland. That's the first Scotland. Freedom!
But here's the problem. All of the people you saw on the show all specifically said that they had put their last dollar into this. They had put their last dollars. The people on Reddit had put their last dollars. My friends that tried this had put their last dollars. There was no money left from the Reddit community. Or if there was, we were starting to run out of funds from the Reddit community. We were getting to the end. We were close to the end of the actual buying power. The moment the buying power stops, what happens on these stocks? When there are no more buyers, well, the first selling pressure kills the stock. It's the exact opposite of a stock market crash. The picture of these meme stocks all look like the opposite of a stock market crash, right? The stock market crash, the stock is tumbling. All of the sellers are out. People are selling. The difference is you have a finite number of people that can buy stocks, and you in theory have way more people that can sell stocks.
So if the stock price begins to rise unexpectedly, then nervous short sellers may start buying back their shares to stop their losses.
But people are selling the stocks. And when all the sellers are out, what happens in a stock market crash? The stocks start turning, because now you have no more sellers, and the only people that are buying are institutional money, and individuals buying are moving that stock, and the stock rallies. No more sellers, you get an uptrend. No more buyers, you get a downtrend. So Robinhood put a stop on the buying of stocks, but they were going to run out of capital regardless. So whether the stock stopped at 400 or 500 or 600, you're right. Had Robinhood not done that, it could have perpetuated that.
I imagine it would have been significantly worse if we prevented customers from selling.
It could have kept it going a little bit longer, but the capital was close to running out. And the idea that the short squeeze would have continued and exasperated, I think is fictitious, because by then a lot of shorts had been covered. At that point, it was really retail purchasers versus retail sellers. So yes, Robinhood stopped the buying of shares through their apps. You could still buy them a whole bunch of other places. The idea that this somehow caused the collapse of the stock is completely completely false.
But people were asking for an explanation. Why did Robinhood have to turn off the buy button?
The stock stopped going up because the buyers were done. Capital was done. Robinhood prevented people from buying a stock at an all-time high. All-time high. And if you tell me that the stock would be higher today, you really don't understand the stock market, because eventually what happens to a stock after a period of euphoria is that stocks are a reflection of their true worth and the net present value of the cash flow of that company. Now, if there's no net present value of the company, like it's a growth stock, for example, it'll trade on some sort of multiple or on an asset basis or on a potential future multiple, but they are worth something, right? Stocks are a representation of something, a concept, earnings, future earnings, or assets. It's something. It's not just a number out of the air. But the stock at the time was not trading on anything rational. It was trading on pure emotion, pure, raw emotion.
It just took off. Mad dash. Stock was flying up. Dun 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 dun. Happy Wednesday. Happy GME 30. Let's go.
And it's not my job to make a decision as to whether or not Robinhood made the right call or the wrong call. Personally, I would have preferred they let the market forces play itself out. I would have preferred to see the stock go up a little bit more and then crash, because that is what we should do. We should have an open market. We should not have rules, anything preventing us from trading. But in reality, Robinhood likely saved a lot of people a lot of money. And I do want to touch on that. And I do want to finish and emphasize this point, is that market forces should be open, should be transparent. So I am not in agreement with what Robinhood did. That's tampering with the market. They shouldn't do it. And whether or not something was happening in the back or not, I don't really care. On its face, it's not right. Okay. You should allow the market to be pure and transparent at all times, because that's what it's a basic tenet and a basic principle of buying and selling securities, that you know how many people are buying and selling, and you can always buy and sell your securities.
Market manipulation is knowingly spreading false information about a stock, which can make the stock go up or go down.
So unless you have predetermined rules, such as triggers or such as switches that get triggered at certain period of time on 10% or 20% movements in stocks, unilaterally stopping people from buying stocks, I don't think it's right. But regardless, I don't think it ended up causing losses. I think it ended up preventing losses for the retail investor. Second thing we wanted to discuss here is this concept, this theme in the show about how the Redditors stuck it to Wall Street. Let me ask you this. Who do you think was buying the stock at the all-time high at $350, $400, $450? Do you think it was, me and institutional portfolio managers and Morgan Stanley and pension funds? No, it was Redditors and GameStop purists that were taking this ship to the moon.
It felt like all the pieces were now adding up to something much bigger. All that was missing was a critical mass of interest in the stock to send it to the moon.
We now know, a year or so after, we now know that that was a losing proposition to buy that stock at that price. It's clear now the stocks were significantly less. We know that that was a mistake to buy that stock at $300, $400 US. So who do you think lost out on that trade? Do you think it's guys like me, or do you think it's the Redditors? I'm not trying to throw it in their face here. I'm just trying to think this through logically. Yes, there's a lot of people that made money early on in this trade. There's a ton of people that got in real early, made a ton of money, probably sold or kept some way too long, but hopefully made a ton of money. But there's a lot more individuals that lost a lot more money at the back end of this trade, when the rocket ship needed to be pushed to the moon.
One of the things that we understand in this soap opera is that someone's going to get killed. We just don't know who it is.
Individuals had to put their savings, their $10,000, $20,000, $50,000 into the stock in order to prop it up. Those all bought at $200, $300, $400. How do you think they're faring today? They're down a ton. They're down a boatload. And they are the ones that did most of the buying at the tail end. They're the ones who got hammered hard. Yes, some hedge funds lost, absolutely. But largely, I guarantee you, the losses are much bigger on the Redditors, and you're never going to hear about it because they're never going to talk about it. It's a lesson learned. They're moving on, and they're turning the page. And it's unfortunate. It's unfortunate that this was the experience. And I think if you go back to my videos back at this time, I was saying, unfortunately, some people are going to learn a lesson the hard way here. And the lesson is going to be, you can't be buying stocks on an irrational basis when it's flying through the moon and going up 10, 20, 30, 40% every single day for a month straight. You cannot get on that ship. It's just a bad idea. It's a bad idea to get on that stock because it's not trading rationally. At some point, it's going to be a reflection of the real value of the stock, and that's what we're seeing today.
The larger hedge fund managers, will become comfortable and they'll be in it together.
Various hedge funds, including Citadel and Point72, were all betting that GameStop's stock price would go down.
I think overall, the GameStop saga was one of the coolest things that I went through in my career. I really loved it. I was following it every day. I mean, had I had a little more intestinal fortitude, I would have shorted the stock, but I didn't. Why? Because I was too scared, right? The stock was on fire and it was going up and up and up. It was a very, very tough short, even though I knew categorically that at some point it would be much lower than it was on that day. I wasn't prepared for the possibility of it going to $600, $700, $800. I didn't have a plan in place for that. So I did not short the stock. I stayed away. I watched from a distance and I took notes and I learned a ton. One of the remarkable things I think that we learned is that there is power. There is power now that didn't exist in the past in the retail online community when it comes to moving stock prices.
There is a power shift, and I think it's important to acknowledge that literally TikTok and Twitter and Reddit, they become forums for information and they clearly can move markets.
And I think that's neat. I think that's awesome that the Reddit community and other communities are able to influence the market. And I think that Wall Street has to be aware of this. And I think it's going to change how people perceive it in the future and how people react to those situations in the future. Now, should the SEC or the Securities Commission have gotten involved here and tried to protect individuals with their money? Personally, I think no. I think you need to let transparent forces act, and I think you need to let individuals learn a lesson, whether that's hedge funds who got cleaned out because they were shorting and they were convinced that these Redditors were going to run out of funds before they actually did, or whether it's the actual Redditors that were buying this stock at $400. Lesson need to be learned. And again, it's why we practice prudent money management, because we're never going to get caught in these shorts. I like the documentary. I thought it was a fantastic watch. I do think whenever you watch these things, you have to take them with a grain of salt, and you have to take a perspective of what message are they trying to send? What's the angle here and how much of it is truth? But regardless, it was fun to relive, which was an interesting saga. Let me know what you thought about the documentary. Don't forget to like and subscribe, guys. Give us a follow. And if you'd like to book a no obligation consultation to chat about this or anything else that's on your mind, go to www.speaktorob.com. We could book a no obligation consultation for you and your family to chat about this or anything else that is on your mind. Guys, I'm Rob Tetrault, Portfolio Manager at CG Wealth. Thank you for taking the time. I'll see you in the next video.